Jared Faltys and got a Lupescu. We're here to provide a quarterly update on the market, and it's really been a great market overall. Been kind of an up and down, and this is kind of the tale of two stories here, I guess. The first quarter was interesting, just with the conflict overseas. We saw really a decline in some of the part of the market, but really our portfolios, we'll talk about that, just how they hung in there very nicely. Diversification really paid off. So with that, I'm going to go ahead and change the presenter to you, Paulo, and welcome. It's great to have you back and learn from you again. So
it's great to see you. Thanks for the invitation, and thanks to everyone for joining. And as you said, it was an interesting first part of the year because there's so much that happened. I mean, if you go back to January, we had the whole situation in Venezuela, and that seemed like a crazy thing. And then we had the Supreme Court ruling on tariffs, and that was a big thing. And then all of a sudden, like, here's a big war in the Middle East, and that's another big thing. So how did the market do through all this? And I think that the interesting thing is that last year in 2025, we did have a good year. The market went up about 18% or so well above the long-term average. And when we started the year, when we look at January, I think what's fascinating, and Jared, I trust that you can see my screen now.
I can, yes.
Yeah. So when you start in January, it was a positive month. So despite Venezuela and all that, it was a positive month. And then we had February, which is a slightly negative month, but not that crazy. And then we had March, because at the very end of February we had this war, and then the market dropped 5% in March. Now, the one cautionary tale that I'll come back to this is not to read too much and draw the causality. Oh, the war happened, therefore the market dropped in March, and in fact for the entire quarter, when you look at the first quarter, it was a negative 4.3%. It's a little more complicated than that. And the first thing that makes it a little more complicated is that within this negative 4.3%, which is the performance of the market, you have the underlying performance of 500 different companies. And what's fascinating, Jared, is that if you look at their performance, it's identical to what it was in the first quarter of 2025. So if you go back to the event that we had exactly a year ago, the performance of the market was absolutely identical. So don't read too much into the performance of the first quarter, because again, second, third, fourth quarter last year were very positive, and the market was just it did phenomenally well. So just because the first quarter wasn't that good, or just any one month, don't read too much into it. Don't try to extrapolate and figure out, oh, this is what's going to happen in the future. At this point, I have no idea. But the second thing, as I mentioned, these are the 500 companies that make up this index. And when you look at their performance, what's remarkable is about half of them, 47%, did go up in value. Almost half, a little bit less than half, they did go up in value. And in fact, Jared, I don't know if you're a photographer, but for years I've been using these memory cards to stick in your camera, made by SanDisk. And it turns out that for the first 3 months of the year, this is through March, SanDisk, this company, who is part of the S&P, went up over 160%. So fantastic performance from this memory card. You also had Dow, the chemical company, went up about 80%. You had Moderna, the vaccine maker, up 70%. You had energy companies. So the market, actually, there are a lot of bright spots in the market, but there are companies that didn't do very well, and some of them not necessarily associated with oil. You have Estée Lauder, which is the cosmetics company, that was down about 30%. You had Ares, which is a private investment company, and that was down about 30%. You had Robinhood, that has to do with trading and all that, and that was down 30%. So it wasn't exactly clean to say, aha, this happened, and therefore that's what happened in the market. Not at all. And when you look at this negative 4.3% for the market as a whole, to get from those 500 numbers to that single number, you have to account not only for the performance of these companies, roughly positive, roughly half positive, half negative, but as we talked over and over before, you also have to look at their size. The larger the company, the greater the emphasis, and that's why these Magnificent Seven have been remarkably important to the US market and the economy, not just because they have to do with AI and technology, but these Magnificent Seven, that's NVIDIA, Microsoft, Apple, Facebook, Amazon, Google, and Tesla, when you take them aside and you look at the first 3 months of the year, the market was down about 4.3%. These 7 companies on average went down significantly more, 11.3%. Significantly more. And what's remarkable is that they left it holding the S&P. So if you look at the S&P 500 minus just these 7 companies, and you call it the S&P 493, the rest of the market for the first quarter didn't really drip that much at all. It was pretty much flat. So when you're, when you kind of infer, oh, look, the war was really bad, oil prices went up, and the market tanked. I'm not exactly sure that I can associate Facebook and Google and Nvidia with the price of oil. And they're the ones that really dropped the market. The rest of the market was pretty flat, was pretty fine. And we'll come back to this in a second. And as you pointed out before, the reason for that is because these Magnificent Seven are a very large part of the S&P, namely about 32% of the value of the entire S&P is in these 7 stocks. So it's quite concentrated, and not as much as a NASDAQ, which is about 51%. The way that we approach investing and globally, I think what's interesting is that the same 7 companies will be part of a global allocation, but you reduce the concentration risk. So if you look roughly, and these are rough numbers to get an idea, through Q1, so this is through Q1, you had S&P down about 4%, give or take. You had NASDAQ down about 6% because it's more heavily concentrated into these Mag 7, and you have the global portfolio down about 2%, so a lot less because it's not as concentrated into these Mag 7. So that's really important to know that it's kind of hard to associate the war with the market dynamics. It does not appear, if you ask me, that for the first quarter the war was so dominant. The market was flat, excluding the Mag 7, which don't have that much to do with oil, and they're the ones dragging now. Now, what's remarkable is over the past month. So if you look at the last 30 days or so in April, it's just how much that flipped. Then now the Magnificent Seven had been on the tear for the past 4 months, 4 weeks or so, to the point where if you look today at the numbers as of today, for example, what you see is that the S&P 500 is actually up about 5.7%, and this is as of today, 5.7%. But the Magnificent Seven have done so well, such that the NASDAQ is now up 8.7%. So the note here is not to say, oh, I should be there. The note is that, folks, you ought to participate in the Magnificent Seven. You also want to be careful about concentration and not put too much, just in case we have a repeat of what happened in Q1. But secondly, if you look on the news and you don't see exactly the same performance in your own account, nothing went wrong. Because I do believe that McMill does not have a goal of giving you the NASDAQ performance, because if that was the case, frankly, at that point, you'd have more than half your money in 7 stocks, which is not necessarily prudent. So again, good news to report. I mean, I think that what is in a way surprising is that if you look at all the nuttiness and everything that's happened, and somehow the US stock market is plowing ahead and doing so well. If you look at the S&P, again, that broad measure, almost 6% up for the first 4 months, despite all the things that we deal with. I think that all of us should be, have a smile on our face, because this has been a remarkably eventful year, and the market has been incredibly resilient.
Yeah, I totally agree. Would you happen to have any kind of information on the volatility of the market? I've seen some information about just how volatile the conflict was and is, I guess, over the last couple months in comparison to maybe other events. Do you have any information?
Yeah, I don't have that particular data in front of me. What I can tell you is that particularly when an event like this happened and the war, and before we get to the war, Jared, I think that it is really important to acknowledge sort of the human element of any conflict, and the fact that maybe some families on this call might have members, spouses or kids deployed in the Middle East, and it's really scary to know that they're in harm's way. There's suffering on all sides. There's bombing and there's buildings destroyed, and it's just all this is just really hard to watch and to think, boy, we're in 2026 and have to deal with this. And what I also find is that these images and the just the anxiety of having family members or friends deployed does create emotions, and those emotions they do impact us, and I think that's what makes us human. It's perfectly fine. I also, what I've seen over and over is that successful investors are able to disentangle these emotions from investment decisions and really be more pragmatic when they think about their money and the market. Particularly at the beginning of a conflict, you see, all these images, we're back in a war, and then on top of that, you see the market volatility. So the market did fluctuate, and the reason that the market fluctuates, by the way, is not because there is a bug in the system. That's not a bug, it's a feature. I do believe that when a situation like this happens, the markets absolutely need to fluctuate. They almost like it's a requirement for the markets to fluctuate. Because what the markets basically are, when you say markets, it's not a living, breathing organism. Markets is something very fundamental. Markets mean that you and I can go buy ownership in companies. And every single day, if I'm a seller of a share of a company, well, I want to make sure that I get paid appropriately. I'm not going to sell it for too little. And if I buy it, I want to make sure that I'm not overpaying. So what the market's trying to figure out is really help both buyers and sellers and figure out, well, what's the value? What's a fair value to exchange this ownership in a business? And when an event like this happens, what the market is doing is saying, okay, well, let's look at the profits that ultimately drive the value of any business. And how are they impacted by this particular war? So it's not about morality. It's about the pragmatic bottom line of how will this impact the profits of a company. So when the war started, if you imagine like there's a U.S. airline that might have flights in the Middle East, well, operations have disrupted. They're not going to make as much money. That business is not worth as much. So what the market's doing is saying, well, it should go down in value, and that's exactly what you see. So it's a good thing that it's going down in value from the perspective that it just reflects how much it's worth it. On the other hand, a defense contractor, you are likely going to see it go up in value because they're going to get more orders, and that's exactly what we saw in the market. But by and large, why is the market not responding more to this conflict? And I think that again, go back to this, that the market is not looking emotionally, it's not pricing morality, but profits. And in that respect, when the market looks at an event like this and say, well, over the next 1, 2, 3, 5, 10, 20, 30 years, that you're going to have ownership in company, in any one company, how much is that company's value? How much are the profits down the road will be impacted by what's going on at the moment? So I do believe that right now, so many people are hyper-focused on what's going on today, next week, next month. But what the market's saying is that, listen, after the initial, take the worst case scenario off. So some of the worst case scenarios have been kind of set aside a little bit, at least an expectation. But what the market's saying that we do think that maybe in a week, a month, 2 months, 3 months, whatever it is, it's a relatively short period of time in the grand scheme of things, that this will be resolved. And when this is resolved, you're still going to have, dozens of years ahead of you in ownership of a company. And I'll make a quick analogy that always stuck with me. I used to develop black and white film. And if you're familiar with a strip of film, to me, the way to think about this is that if you look at 2026 and what is going on at the moment, this is pretty much, it's a scene, it's a frame that we're seeing right now, and it's really in front of us. But when you own a piece of a company, this is not a single shot. It's not a frame, it's not a scene. It's a much longer running movie, because you're going to own a piece of that company for many, 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 many years down the road. And that's what the stock market is trying to reflect, not just the earnings that a company has today or next week or next month or this year, but years and years down the road. And the expectation is that this conflict is not going to last forever. It's going to resolve one way or another. It might be a matter of weeks or months. But again, look at companies and how long they have been paying shareholders. You have companies that have been around for over 100 years. Exxon has been paying shareholders some form of cash payment since 1911. 1911, that's over 125 years or so. So it is interesting that this is a very long-term proposition, and that's what the market's reflecting. And that's why the market is not really dropping. It's not that the traders are just like out there like partying on or like waking up. Well, there's a conflict. Of course, everybody knows. It's just it's a very long-term it's a very long-term proposition.
Yeah, I think you're pointing out just human nature. You know, we get emotional quickly, and with the social media, with news, and just times, I guess maybe we're more emotional quicker, I guess, and
Absolutely
see it instantly. And so
there's
yeah,
another quick element to this. I'll do that very briefly. Listen, we're facing a challenge right now, and the world is facing a challenge with this oil. And there's no doubt in my mind that it's unpleasant. There's no doubt in my mind. But what I found over and over in that when there's a challenge, quite often individuals, companies, the market, and even societies, they come out at the other end stronger, more resilient than they used to be. And to me, a really good example of this is the last time that the US had to deal with a major oil crisis. We're not dealing with that today, and I'll touch in a bit why. But the world is dealing with this. We dealt with something like this in the 1970s. And in fact, 1973, to show their displeasure with the US policies in the Middle East, the Organization of Petroleum Exporting Countries, which kind of had the majority of oil production at the time, they decided not to send oil to the US. And what was interesting is at the time, the government tried to protect people. And they said, well, we can't just let these oil companies charge as much as they want. So they capped the price of gas. It used to be 40 cents after the conflict started, or after the embargo started, it went up to like 50 cents. And that felt good. Well, I'm not overpaying at the pump. The problem is that prices are a rationing mechanism. And if you remove that rationing mechanism, you might feel good about low prices, but what are you going to get subsequently is a situation of shortages. And that's what we had. And that's what we had back then. So folks, when you see, oh, the gas is so expensive, in me as an economist, I say, I'm actually, you know, happy that the prices are allowed to reflect supply and demand. Because if they're not, then the issue is going to be shortages. And what came out of that? Well, instead of these cars, they're not exactly fuel efficient. We introduced some fuel efficient cars and speed limits to make the whole thing more efficient. But more importantly, we developed the idea of energy independence. And over the past 50 years, we really have become energy independent to the point where we actually export oil. But it all started with a crisis. So I look at this, folks, maybe as an opportunity that what comes out of this is going to make the whole world a little bit stronger relative to where it was a year ago.
Yeah, that's very well said. Tough to do, but very well said. It's
yeah, it's tough to do though. When you pay more, I mean, it's painful. You pull out of, wait, am I going to pay? Like I just fill up for $100.
Yeah,
and just one fill up. It's just crazy. In LA, it's like $7 a gallon.
Yeah, right. You know, what else is in the news? You know, inflation's kind of still there, but it's really kind of died down for the most part. We're really not getting the questions from the clients on that.
Well, inflation is likely gonna it's like, you know, it's economics. Inflation is likely to either stick around or maybe even get higher because oil, the same way it was in the 70s, it's a fundamental input to a lot of what we buy. I mean, you know, groceries, for example. Well, groceries get to be shipped from somewhere, and there's gas that needs to be used. So if it costs me a lot more to ship something because of gasoline price, well, that's going to be reflected in the price of products. So it's quite possible that some of these products, it's quite possible that by not having fertilizer and not having any more crops globally, your prices are going to go up in some ways. So there's no doubt there are going to be some consequences. Now, what can you do about it? And this is where it gets interesting, Jared, because I do feel that inflation right now, it is something that we saw in 2022, and it is driven by supply and demand. And what's interesting is that the Fed is trying to respond to this. And this, if you listen to the news that we have a new Fed chairman and what's the idea of the policies with interest rates, the Fed is trying to send a signal, what do we do when inflation hits? And you know, if you are lowering the interest rates, what you're saying is I want people to borrow money. I want people to spend money, and that might encourage prices to go up. So what the Fed is trying to do is exactly the opposite. It's saying, well, if we keep the rates steady or increase them, then there's a bit of a discouragement in spending, and that should bring the prices down. That's exactly what happened in 2022.
Yeah.
But when it comes to inflation, there is something that happened after the pandemic in 2022 that I want to kind of maybe just quickly reflect on, is that there is a bit of something that I think of as a K-shaped recovery. And what a K-shaped recovery basically means is that you have a situation where you have some consumers, and these are basically the folks who are making good money. They have white collar jobs, or maybe in farming, whatever it is, but they're doing pretty well. They're not hurting financially. And it's a minority of the country. It's about a quarter of the country or half of the country or so that is doing it. And their recovery has been quite nice after the pandemic and the inflation. And today, what you're seeing, the prices going up and all that, it's not devastating. It's an inconvenience. I have to pay more, so maybe I have to cut back on. I'm not going to get as many lattes, or I'm not going to go out as much. But it's not a huge inconvenience. Yeah, I pay more at the pump. I'm not happy about it, but it's not devastating to me. So for that portion of the population that had that upward K recovery, it's not really a horrible thing. It's just unpleasant, but not devastating. Now, however, at least half the country is on the other K, which is the lower portion. And this is where it's really troubling, because it might not be folks on this call, but there are plenty of people out there who have to make a choice now between gas and maybe food, or paying medical bills or something else. And again, typically, they don't work with a financial advisor, but they are out there. Many, I mean, I think the majority, more than half the country is in this category that is really hurting. And my hope is that nobody on the call is in that, but I do have to distinguish a little bit between the inflation pain caused to the folks who are relatively okay financially, and it's unpleasant to pay that, but not devastating, versus the truly where it gets really hard, and that's on the lower K of the recovery line.
And we see that if it's not our clients have family members and friends that
Exactly.
we hear that. So yes,
my kid is in that category, I would be honest, and he's, and he's not asking for help, but I can see that he's now he's not nearly go out as much, and he's really trying to. It had a big impact. He's my son, and I'm lucky that he's proud to kind of take care of himself financially, but it's hard.
Yeah. Another question that kind of pops up, and once again, for everybody on this call, I hit to follow up. We don't rehearse at all, so I apologize in advance for the questions. But this is just stuff that we hear from clients. And one of the topics was dividend-paying stocks. Yeah. And why don't you just invest in dividend-paying stocks? Doesn't that make sense? And I don't know if you have any information on that, or maybe if you speak on that. I think your audience would like to hear about that as well.
So let's just define exactly what is a dividend paying stock and what is a dividend to begin with. So if you're a company, and let's say that you are profitable, and you look at ExxonMobil, for example, they've been around for a long time, and they've been pretty much have a mature business, and they make a profit. Now, what they do with that profit is completely up to the company. So as a business, you've made profit, what do you do with that? Well, there are two primary things that a company can do with that. One is they say, okay, well, I'm going to take some of that money and reinvest it, and maybe put it into a warehouse, or in this case, build new facilities or a new pipe, whatever the Exxon might want to do with the money. But I'm just using Exxon just as an example, but it could be any company. I reinvest it in the business, and that's great. And what my expectation is that by reinvesting it, I can make more money down the road. The second thing that he can do is say, well, I actually know that I have all these business owners, the shareholders in the company, and why don't I give part of these profits or all the profits back to them? And it's completely at somebody's discretion. So a dividend paying stock means that the company is mature enough that they're like, hey, I'm making money and I'm okay. I don't have enough great opportunities, and I'm okay paying that to the folks who own the business as shareholders. So what happens when that situation occurs is, let's say a company and you have on your account a situation where the value of your account, the value of a stock, of a share of a company, is $100, and now they decide they're going to pay a dividend. So how does it work now? Well, in an intuitive way, you can say, well, why don't I buy this share of stock I just get the dividend, and then maybe I can share the sell back and I keep the dividend, because you can do that. I mean, theoretically, you can say, I'll buy the share, get the dividend, and then get rid of the share again. And because of that, what the market does, and this is where it gets really interesting, is that when the situation happens, and let's say there's a dividend of about $5 there's announced by the company. This is where most people don't know, but what happens is, in the stock market, the price of the company actually adjusts down by roughly the value of the dividend. So the value of the share is no longer 100, is the price is no longer 100, but it's now 95. Why? Because if it doesn't drop to 95, somebody can just simply buy the share, collect the $5, and then sell the share again. And to kind of mitigate this, the price of the share drops by roughly the same value as the dividend, such that everything else being equal, the value is still 100. The value hasn't changed, and it's still 100. So the first thing to note, folks, is that when you look at these the dividends, there are not a free lunch. You are selling in effect. It's a form of a sale because the price drops and you get the dividend, so the value in your account doesn't really change. And that's something that it's really important to know. Why is that important? Because you don't own as much as you used to. You now own 95 in terms of the value of the company, but there's another hugely important factor. Once this dividend is paid, then this is taxable. So you have to pay taxes on this. And at that point, you're no longer, you don't own, the $5, because part of it has to go to the government. And at that point, again, it's almost like a forced tax that you have to pay, even though the value has not changed at all. So a lot of times, at least I'm talking about my preferences, not to have dividend paying stocks, because I don't necessarily want to pay these dividend taxes at the end of the year if I don't need the money. So that's the first thing, is that when a dividend is paid, pay attention, because the price of the stock drops. So you're not really getting this on top, the dividend on top of the price staying the same. And number two, there are some dividends that you have to pay. The second thing to note is that if you look at the stock market, for example, and you split up these companies into the larger stocks, and that's what you see in the S&P 500, large, well-established, mature companies. Well, these are the likely candidates to pay dividends, because they are the ones that are grown up and mature enough to be able to have these steady earnings and pay the dividends. Now, in the U.S. stock market, you also have smaller companies. And these smaller companies, because they're growing, they might reinvest a lot more, and might be in the stages where they're still growing. And a lot of times they don't pay dividends. For the longest time, Apple hasn't paid dividends, and they were just reinvesting. Eventually, they grew and they blew up. The thing is that if you look at the opportunity to grow your money, it's quite possible that these smaller companies, even though they don't pay dividends, they might grow your money a lot more, and then you can sell yourself as much as you want. You don't have to wait for the dividends. So I do think that is important to know that you could grow your money in other companies that might have more opportunity to grow, and then sell. You can sell that instead of the company selling it for you, like a forced sale of a dividend, as I mentioned a second ago. And the third part is that you already have dividend-paying stocks in your portfolio. The S&P 500 delivers maybe about 1 to 2% in dividend yield every year. So if you just simply hold that, but within that, there are different categories of stocks. And when you hear Jared talk about value stocks, these are in effect the higher dividend yield stocks, the higher dividend paying stocks, and relative to growth, which tend to be more expensive. So you already have value, and these tend to be the higher dividend paying yield stocks in your portfolio. You're not missing out on them. It's just that you're not hyper focusing only on them. And ultimately, the last point that I want to make is that you absolutely should own dividend. But when you have that situation of generating income in retirement, so I need to generate income in retirement, great. This is a very simplistic way to look at it, just buying dividend yield stocks. And in my opinion, you're leaving money on the table. There are much better strategies to take money out than it would allow you for the same baseline amount that you start with to actually withdraw a lot more than just simply putting money into these dividend yield stocks. It's a very complex issue that quite often is relegated to the simplistic view dividend yield stocks. So, keep in mind that the price goes down and you have to pay taxes. Keep in mind there are other stocks that might actually grow up a lot more in value, and then you can sell them yourself to generate that income. And thirdly, you already have dividend yield stocks through value, and you're not really missing out on them. It's just that, in my opinion, you shouldn't hyper focus. If you need that income, just go ahead and talk to Jared and the team and have a plan that is more robust rather than just simply buying those. Because a lot of times these stocks are not going to grow as much as smaller or other parts of the market.
Yeah, Warren Buffett definitely echoes the same thing. He's always said, why should a board in Chicago or somewhere else decide on when I'm going to make that taxable event for you?
Yeah.
And, the perfect world would be there's no dividend paying stocks, and you just peel off the winnings when you need the money. That would be the perfect world.
For me, like, yeah, absolutely. And let my money grow. Let my money grow, and when I want to sell, I can make that choice, how much I sell and from what account. Don't do it for me as a for sale, because that's what I think dividends are for. But they do sound warm and fuzzy. They do sound, oh, but I'm getting this and I'm not selling anything and I'm getting the payments. No, you are in fact selling. You just don't know it. You are selling in the fact that the value of your stocks actually goes down by roughly the amount of dividends. So you're not getting this on top. It's not like an interest payment on a bond. It's not. The value does go down.
There's a myth of some kind of tooth fairy that sprinkles around, and
more complicated than that.
Unfortunately, yeah. Well, that's a great analysis. I know that's it could get complicated, but it doesn't have to be. It's pretty common sense that we don't want a taxable gain if we don't have to have it. So,
right.
Anything else in the media news that we should address for the audience?
The thing that I've heard lately is a little bit about AI, a little bit about gold, the value of the dollar. I'm not sure if any of those are top of mind for your clients.
I know commodities have always come up, and I think that's one of the bigger topics.
Commodities. Yeah, and the commodities, it's an interesting one, and you can include gold in that commodity. I think that what's interesting about commodities is that you can delineate them based on whether there's an economic activity associated with a commodity or not. And in the case of Nebraska, where you are, there's corn, hogs, whatever the agriculture is, and that commodity does have an economic value, and it's quite possible that you might have exposure to that commodity through the business that you're in, and like where you get your paycheck, and how that's totally fine. Now, does it make sense to kind of go any further than that and say I want more exposure to commodities like oil and so forth? And to me, the best way to think about it is that if you own parts of the stock market, and in fact, if you own the global productive capacity, you absolutely have exposure to companies that have to deal with those commodities. And if those commodities go up in price, I'll tell you what, you're going to partake into those. And a great example is if you look last year, a lot of the Canadian stocks did incredibly well because they are in mining and they are in silver and gold. The South African stock market did incredibly well. So you are getting exposure to these commodities, whether it's wheat or whether it's corn or whether it's cacao beans or oil, through the companies that are part of the market, because they're the largest in the world and they dominate this. So if something good happens to commodities, great, you're going to partake. You just don't want to necessarily place additional bets, particularly if you're livelihood is already tied into that. But gold is a bit of a different animal, and if you think of gold as a commodity, because gold for the longest time, I mean, actually going back to President McKinley, was associated with the dollar, because in order for the government to print money, that's what McKinley basically said. President McKinley said, well, we need to have some certain amount of gold in the bank for the U.S. government to print dollar bills. And that was called the gold standard, and it gave people not only confidence in the dollar, but it also put gold on the pedestal, like, hey, it's the precious metal attached to the dollar. And that worked for many decades. But in the late 60s, early 70s, economists pointed out that we are not digging up enough gold to print all the dollar bills that we need. And because of that, in August of 1971, President Nixon goes on TV and he tells the world that as of today, we are no longer on the gold standard. We're going to cut the link between gold and the dollar. And when that happened, you can imagine people are pretty panicked. They're pretty, whoa, wait a second, what are you telling me? Now the government can print dollar bills willy-nilly as much as they want. Well, it turns out that it wasn't the government that was releasing dollars in society, that the law says it's not the government, it's not the Treasury or the Congress, it's the Federal Reserve. And up until President Nixon cut the link and cut that connection between the dollar and gold, the Fed didn't have any latitude. You had to have the gold in the bank. But now, boy, the Fed can do whatever it wants. And in the early 70s, and this is what's so interesting, is that the Fed was not really independent. It was making decisions not based on economics, but based on political maneuvers. And because of that, people lost confidence that the Fed will actually fight inflation. And the Fed will make decisions based on politics. And we had really high inflation in the 70s, in the early 70s. And the economy didn't do well until late 70s, when a new Fed chairman came along and he said, no more monkeying around. The Fed will be fiercely independent, and we're going to make sure that we bring down inflation and reestablish credibility in the Fed. That's exactly what he did. And that's why Fed independence is so important, because we have tried it, folks. We have tried it, and it's a terrible idea. Terrible idea. Everybody's going to tell you it's a terrible idea. We did try it in the 70s. It was horrific. But what happened is, a little bit after the gold and the dollar were unplugged, for a while there was a restriction on the trading of gold. But when that restriction was lifted, what's really remarkable is that people looked at gold and say, well, that's actually maybe the place to go. And what you saw is that over the course of a few years, 4 or 5 years, the price of gold went up fivefold, 5x increase. And people are saying, not only this is stable, because look, it's gold, I have it in hand, it's solid, but also it makes me money. It makes me money. And everybody jumped to buy gold. And when Paul Volcker came along and the dollar stabilized, inflation came down, the economy rebounded, people realized, well, maybe the dollar's not going anywhere. So if you fast forward and you look at the price history of gold after that, what's really interesting is that following that initial buying, panic buying, whatever you want to call it, what's incredible is that we had a period of 25 years, folks, where gold was underwater. It would have taken you that long to recover from the prices in 1980. Up until the first decade of the 2000s. So an incredibly long time when gold did nothing. Gold was underwater. And then you had another stretch where during the financial crisis, where people looked and say, aha, this is gold, I need to jump all over it and let's just do it. And it's a safe asset and all the things that you heard. And following that, when the dollar didn't go anywhere, the economy rebounded, another 10 or 15 years with nothing. I mean, nothing to show for in gold. And more recently, geopolitical risk, central banks, marketing, fear, anxiety, whatever reasons you want, once again, a spike in the price of gold. And to me, history doesn't repeat, but it certainly rhymes. So have we seen times before when there's this sort of a, whatever reasons it makes the gold go up based on sentiment, because it doesn't have an economic value? And he's like, yeah, we've seen this, and you could make money. I mean, if for real, you can increase your value despite these very long periods of being on the water. $1 invested in gold, it would have increased 26-fold, 26x increase in the value of gold since the 70s. And it's just the thing is that when you say yes to something, you say no to something else. If you put the dollar to work in gold, well, what else could you have done with that? And let's just say you put in the market in the S&P 500 over the same time period, and you would have made more money. The question is how much more? And the answer is quite a bit more. Instead of 26-fold, it's 293 times increase in your money, significantly more. So yes, you could buy gold. It's just that it's a commodity that doesn't have an economic activity. It's driven by sentiment, and every once in a while there is a craving, and you know, central banks or consumers are buying gold, but then you have long stretches of just underperformance, and as a whole, it just seems that you're better off buying stocks in the market, because you will have gold mining stocks like Newmont, like those South African, like the Canadian. And when you do that, you have exposure to gold. I just don't believe that you necessarily need any more gold, in my opinion, beyond that. And if you think, well, I'm going to go buy it at Costco because if something bad happens, I have gold. I'm not sure it's that useful. Like, you know, what are you going to do? Take the bar and start shaving a little bit to buy milk? You would toss it in intruders. It's really more of a relic of an asset class than something that necessarily has a tremendous value. So to me, you know, buy gold through the mining stocks, and if you really want to have gold, maybe the best way is buy your spouse a pretty nice piece of jewelry, and great, enjoy looking at it, and maybe one day it'll have greater value.
Well, I have a problem buying an asset to where if I need to liquidate that asset, I have to take it to a strip mall. I just have a problem.
That's funny. That's funny. And your neighbor, I mean, Warren Buffett, for the longest time, has said, listen, if I put a brick of gold on the table and I come back in 20 years, it's still going to do there. Nothing has changed. It hasn't produced anything, hasn't laid any eggs. It has nothing. Whereas if you own some fields in Nebraska and you plant some corn, you sell it, there's that economic activity that generates economic profits. And that's not happening with gold. It's all driven, in my opinion, for the most part, by sentiment. How central banks, how individuals, a lot of sentiment, and really not something that I'm very comfortable suggesting that you got to pile a bunch of money in.
Yeah, totally agree. You know, it's gold and silver from time to time that pops up, and usually it pops up when there's some kind of so-called crisis in the media, and it's like, what are you going to do when there's that crisis in the media? You're going to take this bar of gold and do what with it? So, yeah.
You're going to get pitched. I mean, realize that there's a marketing armada, there's a marketing machine targeting you, that investor who has money, and they want to sell you gold, and they make a lot of money out of this, and they're going to sell you fear. They're going to make a newsletter that sounds like the world's falling apart, and the only thing that you can do to save your family is buy gold.
Yeah.
And you got to be cautious. And if something like this hits your radar, my suggestion is bring it to Jared. He'll come look at it. The McMill team is going to just, you know, look and analyze, is this something valid, or is this more trying to tap into emotions?
Yeah, totally agree. And yeah, and that's brings up a good point. You know, we just want to be a sounding board. We're not going to take your idea and say, well, that's a bad idea. I mean, we want to be a sounding board. We want you to hold us accountable. We want to hold you accountable, and that's how we, you know, can get better and stronger and things like that. It's almost like we're lifting weights or something, trying to get more healthy or something. But yeah, it takes two parties, and we can't do it alone, and we have to have your help, and you have to have our help, and I think that's what's cool about it. So. Well, with that, you know, great quarter year to date. Hopefully we can keep that going, but if not, that's why we stay diversified. And you know, if things change, we're gonna sell high and buy low, is called rebalancing, and that's our promise to you. So, but with that, I'm gonna go ahead and close the webinar. As always, a great basic financial education from a very knowledgeable economist out there, and love having you on the call, Paulo, and hope to have you on next quarter.
I hope so too. Be careful what you wish for. I always enjoy doing these.
All right. Thank you, Paulo, and have a great day.
Bye-bye.
Goodbye.